Even if you're a complete beginner in trading, you must have come across the term scalping at some point. The main goal of scalping is to make a profit through buying or selling an asset for a very short period of time and closing it for a small profit. However, you should be aware that this trading style will demand a certain amount of time and concentration, and if you aren't able to dedicate a few hours a day to this, then this 1-minute scalping strategy might not be the best fit for you. Now, for this strategy, we'll rely on exponential moving averages. A single moving average gives you the general trend of price movement. However, a lot of traders typically use 2 or more moving averages to gain a better feel for the main direction and to trigger more precise entries or exits in the market. That's why we'll use a trio of moving averages to monitor the short, medium and long-term trend of a market, and will allow us to estimate the trend's intensity from multiple time frames. So here we have the 1-minute chart of Euro-Yen, which displays 3 exponential moving averages, the 50, 100 and 150 period averages. The 50 period EMA gives me the short-term trend. The 100 and 150 period EMAs give me the medium and long-term trends. Of course, this is my preference. I prefer to use longer-term EMAs to try to eliminate the inevitable market noise. Any number of period combinations can be used, depending on the types of setups you are looking for and the time frame you are trading. So feel free to use other moving averages, you don't have to use the exact setup. Looking back at this chart, notice how price pushed above the 3 EMAs and traded steadily higher, the price staying above the 50 period EMA the entire time. The fact that all 3 EMAs were trading higher at around 45-degree angles during the advance was very bullish. This is the image we'll search on our charts, meaning all 3 moving averages in agreement, in line, almost parallel, with strong trend consensus. Right here, the price eventually broke below the 50 period EMA, which signaled short-term weakness, but bounced off the 100 period EMA before resuming the uptrend, thereby confirming the medium and long-term strength. Until the price breaks below the 150 period EMA, the bullish trend will remain intact. After we identify the main direction, we need to wait for a pullback. So we'll search for a pullback trade to pinpoint undervalued and overvalued entries into established trends. So our goal is to find opportunities when price is considered overvalued or undervalued, as this presents excellent opportunities to buy low during uptrends and sell high during downtrends. The idea of the pullback trade is to buy the market at discount during an uptrend and sell the market at a premium during a downtrend. The goal of the pullback trade is to take advantage of situations when price is in an established trend, either bullish or bearish, and all 3 moving averages are indicating the same direction. Any pullback to the first or second EMA offers a buying or selling opportunity back in the direction of the established trend. This setup is effective because it forces you to buy below value and sell above value, while keeping you disciplined to the existing trend. Now, how to enter a trade? So the first step, the most important one, is to identify the current trend of the market. I know I'm repeating myself, but I want this to be crystal clear. All 3 EMAs must be trending in agreement in a bullish or bearish manner. Ideally, you want to see all 3 EMAs trending at a 45-degree angle, which identifies a strong trend. However, any slope ranging from 30 to 60 degrees will work just fine. The second step involves waiting for the market to pull back to test either the 50 or the 100 period EMA. Price can close beyond the 50 period EMA, but you generally don't want the price to close beyond the 100 period EMA or be near the 150 EMA. Once the price tests either of the moving averages, we need price confirmation. The entry is triggered when the price closes back in the direction of the current trend beyond the 50 period EMA. How to manage the trade? There are many exit tactics that can be used for the pullback trade. Before you select the type of exit strategy, you should first remember you are scalping. The room for error is extremely small. Let me repeat that. Margin for error is very small when you are trading with high leverage while looking for a small profit. Here is what I do when I'm scalping. I move my stops to break even as soon as possible. You want to diminish your risk. You will get stopped out a lot of break even, but from my experience it's better to have 5 trades in a row with 0 profit than 5 losing trades. That's the ugly face of scalping. It's very unpredictable and any price swing can hit your stop loss. That's why I look to play the break-even trade when I'm 5 or 6 pips in profit. You will be frustrated when you have 5 pips in profit, move your stop to break even, and the market will hit your stop loss and will continue in your initial direction. It will happen, but this will protect you in the long run. If you have a bigger risk aversion, here are other tactics you could use. A traditional trading profit stop, a fixed profit target, or exit at the near support and resistance levels, or at the Fib extensions if you trade with Fibonacci numbers. This chart illustrates a perfect example of choosing a currency pair during an established trend. Notice that all 3 EMAs are trending lower at 45-degree angles, which is important because this is a measurement of trend intensity. Trading in the direction of an established trend increases your chances for a profitable outcome. Now that direction has been established, we look for price to break above the 50-period EMA in order to set the stage for a sell scenario. Once price dips above the first EMA, we look for price to close back below the 50-period average in order to trigger a short position, which occurred several times in this chart. Also, remember that you can use any period moving average you like to manage your trades. You could backtest different settings and adapt the period of the EMAs to fit your style. Once in a trade, I immediately set my stop loss below the low of the pullback I am trading. Therefore, your stop loss would be beneath the low of the bar that tested the 100 or the 50 period EMA. Here are other examples of scalping trades on EuroJPY, DAX index and Dow Jones index, my favorite instruments to scalp. So what's the psychology behind this trading technique? We try to take advantage of novice traders shorting the market below 50 EMA. Think about it, we are practically waiting for the price to close below the 50 EMA. But other traders, when they see the price closing below the 50 EMA, they immediately short the market. They don't care about the general trend. They see the price below the 50 EMA and enter short. That's why we wait for the price to return above the 50 EMA. We want to have trapped traders below us to fuel our long positions. Where are the stops of the traders shorting below the 50 EMA? You guessed it, above the 50 EMA. When the price returns above the moving average, our scalping trade gets an extra boost from the stops of trapped traders. Here are some important observations. Scalping can easily turn to gambling. Excited traders on a winning streak will abandon their own rules in pursuit of fast money. If this happens once, it can easily happen again. Being impulsive is one of the most undesirable traits for Forex scalping. That's why try to improve your discipline and self-control before attempting scalping. Second, scalping is one of those trading methods that are often performed with bad risk-reward ratio. A trader will often risk 100 pips just for the possibility of gaining 1 or 2. Market provides plenty of opportunities to enter high probability setups that you can make this reward sustainable. Unfortunately, this trading style also means that days and weeks of profits can be wiped out with relative ease. Few bad trades in a row can therefore produce substantial losses. That's why when I'm scalping, I'm not risking more than 0.5 of my total balance. Not 5%. 0.5. So if you have $5,000 in a trading account, for example, if you scalp, risk at most $25 per trade. My third recommendation is to lower your lot sizes. Small lots help you keep losses down until your trading improves. The smaller the Forex lot size, the lower the risk. Also, don't neglect the trading costs. Scalping requires frequent trading almost by definition. Frequent trading also means frequent and substantial position entry costs. Small difference in spread between a great broker and a good broker may be the difference between a consistently winning strategy and a consistently losing setup.